When people talk about African independence, the story usually sounds finished. Colonialism ended, countries became independent, new flags, new governments, international recognition. So the assumption is that the past is the past. But independence was never just political. It was supposed to be cultural, it was supposed to be social, and most importantly, it was supposed to be economic. And that last part, economic independence, is where the story gets uncomfortable. Because even after independence, African countries didn't suddenly reset. Colonial languages remained official languages. Colonial education systems stayed in place. Colonial legal and administrative structures continued to shape governance. So while power changed hands politically, many of the systems that organized daily life never really left. And the same thing happened economically. Today, there are African countries that are fully recognized as independent states, but still use currencies that are directly tied to their former colonizers. For example, countries like Senegal, Cote d'Ivoire, Mali, and several other West African countries use the West African CFA franc. Cameroon, Chad, Central African countries also use a version of the Central African CFA franc. Other countries around the world still use currencies inherited from colonial rule as well. These are not accidental holdovers. They are formal monetary systems that still exist today. And this matters because money isn't symbolic. Who controls a currency affects interest rates, access to credit, government spending, and long term economic planning. If a country does not fully control its money, its economic choices are limited, no matter how independent it is on paper. So the real question isn't whether African countries are independent in name. The real question is who controls African money? And what does that mean for countries that are politically independent but economically constrained? Welcome back to They Lied About Africa. I'm your host, Numbe, and if nobody told you the real story, I will. In this episode, we're going to focus on economic independence, what it actually looks like in practice, why control over money is central to it, and how historic economic arrangements continue to shape African countries today. And more specifically, we're going to be using the CFA franc as a central case study. We'll look at what it means for a country to control its own currency, how the CFA franc system works, who has decision-making power within that system, and why this arrangement is often misunderstood as aid or stability. This isn't about opinions, it's about structure, because you cannot seriously talk about African development without talking about money. And you cannot talk about money without asking who controls it and under what rules. So if you ever wondered why independence hasn't automatically meant economic freedom or why Africa's relationship with its former colonizers is still shaping the present, this episode will give you the context most conversations leave out. Let's get started. So before we answer who controls African money, we need to be clear about one thing first. What does it actually mean to control a currency? Because a lot of people hear currency and think that just means cash, coins, or what's in your wallet. But money is much bigger than that. See, when a country controls its currency, it means three basic things. First, it decides how much money exists in the economy. Second, it decides how expensive it is to borrow money through interest rates. And third, it decides how currency interacts with the rest of the world. Those decisions are usually made by a central bank. And they affect everything from prices to jobs to whether a government can respond to a crisis. So this is not abstract or technical. If a government wants to invest in infrastructure, support local industries, or respond to inflation, it needs monetary tools to do that. And without control over its currency, those tools are very limited. See, in most countries, the central bank is domestic. It may be independent from politicians, but it ultimately serves the national economy. See, the country holds its own foreign exchange reserves, sets its own monetary policy, and can change course when economic conditions demand it. That flexibility is a big part of what allows countries to grow, stabilize, and adapt. This is why money is power, not because of greed, but because currency control determines who gets to make economic choices. It decides who gets access to credit, how much a government can spend, and how an economy responds to shocks. So when a country does not fully control its currency, its economic independence is constrained, even if its political independence is recognized. Now, here's where this matters for Africa, because while many African countries are politically independent, their monetary systems don't always follow this model. See, in some cases, key decisions about currency, reserves, and policy are shaped by arrangements created during colonial rule and maintained long after independence. So with that baseline in mind, what controlling a currency normally looks like and why that matters, we can now look at a specific system that operates differently. And that system is the CFA franc. And before we talk about whether it's good or bad, we need to understand what it is, where it comes from, and who uses it. See, the CFA franc is a currency used by 14 African countries, like I listed earlier, mainly in West and Central Africa. There are actually two versions of the CFA franc, if you remember me mentioning them earlier. One used in West Africa and one used in Central Africa. They're issued by two separate regional central banks, but they operate under very similar rules. The important thing to understand is that the CFA franc is not a national currency. It's a shared currency system that was created during the colonial period and maintained after independence. In West Africa, countries like Senegal, Cote d'Ivoire, Mali, Burkina Faso, Benin, and Togo use the CFA franc. In Central Africa, Cameroon, Chad, Gabon, and the Central African Republic use it as well. All of these countries are fully recognized sovereign states. They have presidents, parliaments, and national governments. And politically, they are independent, but monetarily, they are connected to this shared system. So the CFA franc was created in 1945 during French colonial rule, and at the time its purpose was pretty straightforward: to integrate African colonies into the French economic system. When these countries gained independence in the 1960s, the currency system did not disappear. Instead, it was restructured, renamed, and preserved through agreements between France and the newly independent states. So while colonial rule ended formally, the monetary framework remained. Now, this is important. The CFA franc is often described as providing stability, and don't get me wrong, it does. Inflation in CFA franc countries has historically been lower than in some other regions. So this isn't a cartoon villain situation. There are real reasons governments agreed to continue using it. But stability comes with trade-offs. And to understand those trade-offs, we need to look at how the system actually works. So one of the defining features of the CFA franc system is that it's pegged to an external currency. Originally, it was pegged to the French franc. Today, it's pegged to the euro. That means the value of the CFA franc is fixed relative to the euro. It does not float freely based on local economic conditions. Here's a way to think about it. So imagine you have a bank account, but the rules of that account are tied to someone else's finances. Your income might change. Your expenses might change. Your needs might change. But the rules of your account do not adjust to you. They adjust to someone else. So even if your situation calls for flexibility, you're locked into a system designed around different priorities. That's what a fixed currency peg does. Now, remember what we said earlier? Controlling a currency means being able to adjust policy based on national needs. But when a currency is tightly linked to an external one, those adjustments become limited. Interest rates, monetary supply, and exchange rules are shaped less by domestic conditions and more by maintaining the peg. This doesn't mean governments have no control, but it does mean that their control is constrained. And this is the key point. The CFA franc is not a temporary arrangement. It's not a leftover mistake. It's formal, structured monetary system with rules, institutions, and long-term consequences, which means it is worth examining carefully, not emotionally, not casually. So, now that we understand what the CFA franc is, where it comes from, and which countries use it, the next question becomes unavoidable. Who actually has decision-making power inside this system? And that's where we need to look at how the CFA franc works today and the role external actors still play in it. So to understand how this CFA franc system works, we need to look at three things: where the money is held, who makes key monetary decisions, and what limits exist on policy choices. Once pieces are clear, the issue of control stops being abstract. So I guess I want to start with this, right? Every country that uses a currency needs foreign exchange reserves. These are assets like dollars or euros that a country holds to pay for imports, service foreign debt, and stabilize its currency. Think of reserves as a country's emergency savings account. Like, imagine you have a job and you earn your own money, but instead of keeping your savings in your bank account, a portion is automatically placed into someone else's account. You could access it, but only under certain conditions and under rules you did not fully design either. That's the basic idea behind how reserves work in the CFA franc system. Under the CFA franc arrangement, member countries are required to deposit a significant portion of their foreign exchange reserves into accounts connected to the French treasury. This rule has changed in percentage over time, but the structure itself remains, which means reserves generated by African economies are not held entirely under domestic control. Again, this is not a secret. It's written into formal agreements. Now, let's talk about who makes the decisions. So the CFA franc is managed by regional central banks in West and Central Africa. On paper, these institutions exist to serve member states. But here's where it gets complicated. Certain rules of the system, especially those tied to currency stability and convertibility, limit how much flexibility these banks actually have. Remember earlier when we said that monetary control means being able to adjust interest rates, expand or restrict money supply in response to economic shocks? In the CFA franc system, those decisions are constrained by the need to maintain the currency's fixed relationship to the euro. that peg becomes the priority. So even if domestic conditions call for change, policy options are narrowed. Supporters of the CFA franc often point to one major benefit: guaranteed convertibility. This means CFA francs can be exchanged for euros at a fixed rate. That guarantee reduces currency risk and reassures foreign investors. But guarantees are not neutral. They come with rules. It's like having a cosigner on a loan. The cosigner lowers your risk, but they also get a say in the conditions. You don't default, but you also don't have full freedom. That is the trade-off. And in practice, this system prioritizes low inflation, currency stability, and predictability for external markets. What it deprioritizes is aggressive industrial policy, flexible monetary expansion, and domestically driven experimentation. This doesn't mean that CFA franc countries cannot grow. It means their growth happens within boundaries set by the system. Now, at this point, I think it's important to say this clearly. No one is claiming African governments have zero agency, and no one is saying that these countries are incapable of governing themselves. The question isn't competence. The question is constraint. So now we understand the mechanics, where reserves are held, how decisions are limited, and why stability comes with trade-offs. Which brings us to the next question, the one most people avoid saying out loud. What role does France play in maintaining the system today? And how much influence does it actually have? And this is where conversions often go wrong, because people imagine control as something loud or visible. Colonizers in uniforms, direct orders, public domination. That's not what this looks like. France doesn't directly govern CFA franc countries. It does not appoint their presidents. It does not run their parliaments. The influence operates through institutions, agreements, and guarantees, the kind of power that doesn't need to announce itself. France's central role comes from the fact that it's the guarantor of the CFA franc system. That guarantee is what makes the fixed exchange rate with the euro possible. It's what also reassures international markets that the currency will remain stable and convertible. But guarantees are not neutral. To guarantee something, you need oversight. And to provide oversight, you need influence, especially over rules that keep the system stable. Historically, this influence was explicit. France held seats on the boards of regional central banks and maintained formal mechanisms of oversight. Over time, some of these arrangements were restructured or reduced, particularly in response to criticism. But the foundational relationships did not disappear. France still plays a decisive role because the system itself is designed around its backing. This means that major changes to the CFA franc system, whether it's adjusting the peg, changing reserve requirements, or altering convertibility rules, are not decisions that can be made unilaterally by member states. They require negotiation within a framework where France's approval matters, and that's the key distinction. This isn't about day-to-day interference. It's about veto power over fundamentals. Think about it like this. If you rent an apartment, you can rearrange the furniture. You can paint the walls. You can make it feel like home. But you cannot knock down structural walls without the owner's approval. Political independence gave African countries control over how they govern. The CFA franc system limits how much they can redesign the economic structure underneath. So France doesn't need to dictate policy line by line. The system itself enforces the boundaries. And this is why the conversation around aid becomes misleading, because aid suggests generosity, money flowing freely from one side to another. What we're talking about here is not generosity. It's a framework where economic stability is exchanged for constrained autonomy. Supporters of the system argue that this arrangement protects countries from inflation, currency collapse, and investor flight. And those arrangements aren't baseless. Stability matters, predictability matters. But stability for whom? And at what cost? Because when the economic policy is designed primarily to reassure external markets and maintain external guarantees, domestic priorities often come second. This is why many CFA franc countries struggle to pursue aggressive industrialization, large-scale public investment, or expansionary monetary policy, even when their internal conditions might justify it. Not because leaders don't want to, but because the system limits how far they can go. And that is the core issue. France's role in the CFA franc system isn't about domination in the old colonial sense. It's about structural influence embedded so deeply into financial arrangements that it feels invisible unless you know where to look. Which brings us to the question that naturally follows. If this system prioritizes stability, guarantees, and external confidence, what does it mean for development? And why is this often described as help when outcomes suggest something more complicated? Because economic systems don't just exist on paper, by the way. They shape what governments can do, what businesses can build, and how societies develop over time. One of the most immediate consequences of constrained monetary control is limited policy flexibility. When countries cannot freely adjust interest rates, expand credit, or manage their currency based on domestic needs, their ability to respond to economic challenges is reduced. That matters in moments of crisis, recessions, and commodity price shocks, global inflation. But it also matters in everyday development planning. Economic growth is not just about stability, it's about direction. Developing economies often need to invest heavily in infrastructure, manufacturing, education, and industrial capacity. These investments usually require long term financing, strategic use of credit, and sometimes higher tolerance for short term inflation in exchange for long term growth. But in a system where the priority is maintaining a fixed exchange rate and reassuring external markets, those tools become harder to use. So governments may want to expand spending or domestic industries, but they face tighter constraints on how much money they can inject into the economy and under what conditions. The result is an economic collapse. It's slow, cautious growth. Another consequence shows up in credit availability. In many CFA franc countries, access to credit for small businesses and local entrepreneurs is limited. Interest rates remain relatively high, lending is conservative, and banks prioritize low risk activities. That makes sense within a stability focused system. But it also means fewer startups, fewer locally owned industries, and slower diversification of the economy. When businesses cannot easily access capital, economies remain dependent on exports of raw materials rather than value added production. And that dependency reinforces the same global economic patterns that existed during colonial rule, just without formal colonial administration. This is why the conversation about development often feels stuck, because aid programs focus on symptoms, poverty reduction, humanitarian relief, short term growth, while the underlying economic structure remains unchanged. And that structure determines outcomes. It's also important to talk about fiscal policy here. Governments that don't fully control their monetary environment often rely more heavily on taxation and external borrowing to fund public spending. That creates pressure to keep budgets tight even when social needs are high. So you see countries with growing populations, urgent infrastructure needs, and rising unemployment, but limited ability to spend aggressively without risking financial penalties or instability within the system. Again, this isn't about incompetence, it's about constraints. And over decades, these constraints compound. Small limitations repeated year after year become structural ceilings on development, which is why comparisons between African countries and countries that industrialized later in East Asia or elsewhere can be very misleading. Those countries often had far more monetary and fiscal flexibility during critical stages of their development. So when people ask why African economies haven't caught up, they're often ignoring the rules under which different regions were allowed to grow. None of this means that the CFA franc system, by the way, is the only factor shaping African economies. It isn't. Governance, corruption, global trade dynamics, and internal political decisions all matter, but monetary structure sets the outer limits of what is possible. And when those limits are externally constrained, economic independence remains partial, no matter how long political independence has existed. Which brings us to the narrative most people hear instead. If these economic outcomes are real, why is the system so often described as help, support, or stability? And why does this language of aid dominate the conversation while questions of power and control stay on the margins? And the answer has a lot to do with how development is discussed globally. See, in most mainstream conversations, development is treated as a technical problem. Countries are described as needing better policies, better governance, better institutions. And when outcomes fall short, the explanation is usually internal failure rather than structural constraint. Within that framework, monetary stability becomes the highest good. Low inflation treated as a success. Currency predictability is treated as protection. And any system that prevents validity is framed as responsible. From that perspective, the CFA franc looks helpful. It keeps inflation relatively low. It reassures foreign investors. It reduces the risk of sudden currency collapse. So instead of being discussed as a system that limits sovereignty, it's framed as a system that supports weaker economies. This is where the language of aid quietly enters the picture. Not aid in the sense of direct cash transfers, but aid as protection. Aid as in guidance, aid as restraint. The underlying assumption is that African countries need external discipline to avoid economic mismanagement. And that assumption is rarely stated outright, but it shapes how policies are justified. International institutions like the IMF, International Monetary Fund for those who don't know, and the World Bank tend to prioritize macroeconomic stability in their recommendations. Their models are built around minimizing risk, controlling inflation, and maintaining investor confidence. Again, these goals aren't irrational, but they are not neutral. They reflect a particular vision of development, one that prioritizes global financial integration over domestic experimentation, and external confidence over internal flexibility. So when a system like the CFA franc aligns with those priorities, it's not seen as a problem, it's seen as a safeguard. What gets lost in that framing is trade-off. Stability can reduce risk, but it also can reduce ambition. Predictability can protect economies, but it also can lock them into narrow growth paths. And when those trade-offs are discussed, they're often presented as unavoidable rather than as political choices embedded in historical arrangements. This is why the CFA franc is rarely debated in moral terms. It's treated as a technical arrangement managed by experts, insulated from politics, but monetary systems are always political. They decide who bears risks. They decide who absorbs shocks. They decide whose priorities come first. And when those decisions consistently favor external reassurance over domestic transformation, the system stops being neutral, even if it's described in that way. So the issue isn't stability is bad. The issue is that stability has been elevated above sovereignty, and that elevation is rarely questioned, which brings us to the final layer of this conversation. If the system is so deeply embedded, if it's defended as stability, and if it's treated as technical rather than political, why does it continue to exist, and who benefits from its presence? And what would it actually take for this arrangement to change? So that's what we're going to look at next. And the answer to that question, risk aversion. So for governments, currency exchange is one of the most dangerous political decisions you can make. If a new currency fails, if inflation spikes, or if savings lose value, the consequences are immediate and visible. Prices rise, imports become expensive, public trust collapses quickly. So even when leaders recognize the limitations of the system, the fear of instability can outweigh the promise of autonomy. Stability may be constraining, but instability can be catastrophic. And for countries that already face economic vulnerability, that risk feels too high to gamble with. And another reason is institutional dependence. Over time, entire financial systems adapt to the rules they operate under. Banks, businesses, and governments organize themselves around predictability. Budgets are planned based on fixed exchange rates. Trade relationships are structured around currency guarantees. Changing currency doesn't just mean printing new money. It means rebuilding institutions, retraining systems, renegotiating contracts, and absorbing uncertainty all at once. That kind of transformation requires political unity, technical capacity, and public trust, and in many cases, those conditions are difficult to align at the same time. There's also the issue of external pressure, even when it's subtle. International markets tend to reward predictability. Credit rating agencies, investors, and lenders prefer familiar systems. A country that signals a major shift in monetary policy can be quickly labeled as risky, even before any outcomes are visible. So the incentive structure pushes countries to maintain the status quo, not because it's optimal, but because it's legible to the outside world. And then there's internal politics. Elites who benefit from access to stable imports, foreign capital, and the international networks often have little incentive to disrupt the system. The costs of constraint are spread across the population, while the benefits of stability are concentrated among those with access to capital and power. And it doesn't mean leaders are acting in bad faith. It means systems reward certain behaviors and discourage others. Over time, these incentives harden. This is why the persistence of the CFA franc system can't be explained by a single villain or a single decision. It's the result of historical arrangements that were never fully dismantled, global financial norms that prioritize stability over sovereignty, and domestic political realities that make change risky. And when these forces align, CFA franc often stall at the same place. People ask whether it's good or bad, whether it helps or hurts. But the more important question is whether countries are allowed to choose freely, or whether their options are structurally limited. Because choice under constraint isn't the same as choice. So then let's talk about this. So then let's ask the real question here. If change is possible, even slowly, what would it actually look like? And what examples exist? What debates are happening right now? And what would economic independence require moving forward? See, over the years, African leaders, economists, and activists have raised questions about monetary sovereignty. Some countries have pushed for reforms. Others have openly discussed exiting shared currency systems altogether. There have been proposals to reduce reserve requirements, to shift governance structures, and to create new regional currencies designed and controlled entirely within the continent of Africa. These conversations exist for a reason, because the limits of the current system are widely understood, even by those who defend it. But change is very slow, not because alternatives are impossible, but because monetary systems are risky, politically sensitive, and globally scrutinized. A currency is not just an economic tool, it's a signal to citizens, to markets, to international institutions. And for countries already navigating global inequality, the cost of getting that signal wrong can be severe. So reforms tend to happen cautiously, incrementally, and under pressure, not all at once, obviously. Which brings us back to the core question of this episode: who really controls African money? Well, I'm gonna tell you the answer is not simple, but it's clear. In many African countries, especially those using the CFA franc, monetary control is shared, constrained, and structured by historical arrangements that continue to prioritize external stability over full domestic autonomy. African governments govern, African institutions function, African economies operate. But the rules under which those economies operate were not entirely written by Africa, and they have not been fully rewritten since independence. So political independence exists, but economic independence remains partial, and that distinction matters. Because when people ask why foreign aid hasn't transformed Africa, or why development seems slow, or why inequality persists, the conversation often skips the most foundational issue of all: power over money. You cannot fully design your future if the most important economic tools are constrained. You cannot experiment freely if the cost of failure is externally imposed. And you cannot talk honestly about development without talking about who sets the rules. That doesn't mean Africa is powerless, and it does not mean change is impossible. It means the story is more complicated than the version most people are told. And that complexity is intentional. Because as long as economic control is framed as help, as long as stability is treated as neutral, and as long as monetary systems are discussed as technical rather than political, the deeper questions never have to be answered, but they should be. Because understanding Africa's present and imagining of different future starts with understanding who controls African money and why. And that's the part of the story that's usually left out. That's all I have for you on today's episode of They Lied About Africa. Until the next episode.